Welcome to the Small Giants Virtual Workshop.
Today, we're thrilled to be hearing from Isaac Presley. Isaac is the president and CEO of Cordant Wealth. So Isaac, I'm going to let you take it from here.
All right. Well, thank you, Rachel, and nice to see all of you today. Thank you for joining. I'm going to go ahead and share my slide here in 1 second. And as Rachel mentioned, we're going to have a series of prompts, things to discuss as a group. So, I'll ask you anytime we're discussing finances. I know that these topics can be a little bit vulnerable or sensitive, but I encourage you to participate. And if you're not comfortable asking for yourself, ask for a friend. Asking for a friend maybe is the way to go today. So encourage you to participate, and bear with me for 1 second. And I'm going to go ahead and share a slide. Make sure everybody can see that. Maybe somebody just give me a thumbs up. Okay, got a couple thumbs up. Thank you. So today we're going to be talking about some foundational financial planning and investment strategies. But just really quick before we get into that, you might be asking yourself, who's this Isaac character and who's Cordant Wealth? So we're based in Portland, Oregon. We work with clients across the country, and our mission as a wealth management firm is to help clients be very intentional or purpose-driven with what they're trying to do with their money. So the way we say it is we're trying to change money from a cause of stress, which money is a number one cause of stress if you look at any of the metrics out there, and particularly in 2020, given everything that's happened, money is a big driver of stress. So what we're trying to do is change money from a cause of stress to fuel for a meaningful life for our clients. So that's who we are kind of in a nutshell. And hopefully a lot of that intentionality comes through everything that we're going to talk about today. It's all about using money to achieve what you're trying to achieve in life. Rarely is there one right answer with finance. Oftentimes the right answer is it depends, and it usually depends on what you're trying to accomplish with your wealth. So that's the lens you should view everything from here on through. So objective with our time today is threefold. So one is that you learn at least one new thing through the presentation. I'm going to try to get you to commit to take one action in the next week. Knowledge is good, but unless we put that into practice, ultimately we don't have the kind of impact that we'd like to have. So I'm going to try to get you to take one action in the next week as a result of this, and then laugh at least once, or have a little bit of fun. Sometimes finance is not the most enjoyable topic or the most fun topic. So we're going to try to make this at least a little bit of fun. So laugh at least once, a smile, a chuckle, a chortle, maybe that works too, but anything to have a little bit of fun here. So that's the objective. Let's get going. One of the things that I think is fun anyway is quizzes or trivia. So we're going to start out with a quiz. This also works as a bribe to get you to stay to the end. We're going to have the answer at the end. So this is a quiz/bribe. So you're looking at Steve Jobs and Tim Cook, two CEOs of Apple over the course of their history. Most of you probably know that already. But the quiz, the trivia here is, Steve Jobs is the legendary founder, visionary of Apple. Tim Cook's the current CEO. The question is, which of these two CEOs of Apple have delivered more value to Apple over their tenure as CEO? So think about that for a second. If you have a pen and paper or something to write down, or if you're on your computer, maybe that's where you're taking notes, I would encourage you to take some notes. We're going to have some prompts and some things for you to do throughout this. So maybe the first note would just be jot down, who do you think has created more value for Apple over their tenure as CEO? That'll be the first piece here, and we'll again come back to this at the end. So I'll give you a second to kind of jot that down, and then we'll get onto our agenda. So what we're going to try to accomplish today is cover really three things with some discussion. So we're going to cover setting financial goals, how to go about that, where to start. We're going to talk about saving versus investing, kind of the differences between the two, why they're both important, and how to think about getting started or look at some of the things that I would consider the right things when it comes to investing. We're going to kind of wrap up the presentation piece with staying on track. Once we've done some of these things, how do we stay on track? And then we're going to have some breakout or a group discussion, some questions that we're going to prompt, and then at the end, going to do a Q&A as well. So be thinking about that as we go along. So let's get into this. The first piece that we want to cover is financial goals. And the first rule of financial goals, this is not the first rule of Fight Club, if any of you are familiar with that movie, but the first rule of financial goals is to set them. I mean, this is just like any goal. You're going to be more likely to accomplish your goals if you set them, write them down, maybe share them with somebody else. That's the first thing we want to do, is make sure to be intentional, to be purposeful with what we're trying to accomplish, and set some goals. Now, one question that we get is, okay, it makes sense. What kind of financial goals should I be setting? Now, there are some fundamental, some foundational goals that we need to think about, and think about this as basically a hierarchy. We need to do these things first, and then we can move on to some other goals, move on to some other goals. So maybe this is appropriate to you. Maybe this is appropriate to somebody else, somebody you work with. If you manage or lead a company, maybe these are appropriate to your employees. If you have kids that are starting to work, starting to earn income, maybe on their own, going to college, etc., maybe these are appropriate to them. So think about it from those perspectives. And at the end, one thing we always do through these presentations is make a couple offers to help. So one of those would be, we do these presentations into companies as well. So if you think some of these things might be appropriate for you, for your workforce, there'll be an opportunity for you to get in touch and maybe bring some of this into your workplace. We always also offer just a quick 15-minute call with you if you want some help to make progress in any of these areas. So that's either going to be with myself or one of our advisors, but we always offer that just 15 minutes. So you'll have the opportunity at the end, but think about this as where to start. So the three foundational financial goals that we always need to start with are these that you see here. So first one is to establish an emergency fund. Second one is to make sure if your company does a retirement plan, a 401k plan match, to contribute enough to get that match. And then the third thing would be to pay down any high interest rate debt that you have. Now, a little bit more details on each of these. So emergency fund, the question there is typically, okay, how much should we be putting into emergency fund? Typically what we want to do is at least 3 to 6 months of living expenses. Now, it's kind of a rule of thumb, right? If your income is very stable, so kind of the classic or the cliche example would be a tenured professor, right? They know what their salary is, pretty high job security. If your income is pretty stable, you might be able to get away with something on the low end of the range, or maybe even less than 3 months. On the other side of the spectrum, if you're an entrepreneur and your income is widely varied from year to year, you probably want to be on the high end of the spectrum, or maybe even 1 year or 2 years of savings, something like that. So as with most things, these are rules of thumb, but that's probably something to think about where to start. 3 to 6 months of living in an emergency fund. Next thing we need to think about is retirement savings match. So oftentimes an employer will match, maybe it's 2%, maybe it's 3%, maybe it's up to 6% of the money that you're putting in, they'll match that. And so if you're not contributing at least enough to get the match, you're essentially leaving free money on the table, right? If your company says you're going to add another 3% to your salary, if you put 3% of your salary into your retirement plan, if you don't do that, you're leaving, basically a 3% raise on the table. So that would be the second thing to think about, is make sure to contribute enough to at least get the match that the money that your company is willing to give you. And then the third one would be to pay down high interest debt. So typically this is like credit card debt. Sometimes it could be other types of consumer debt, but oftentimes these are pretty high interest rate loans. So 15%, 20%, maybe even a little bit more. It's really hard to get the same return elsewhere. And so the other thing that we should be thinking about is one way to pay yourself first would be to pay down this debt that is at a really high interest rate. So that's the third thing to think about there. Once we get kind of these three financial goals in place, we can move on to a couple additional goals. And there's a lot more additional goals that you could move on from, but couple main ones from there would be to go ahead and increase the amount you're saving for retirement. So again, this is a rule of thumb, but like 10 to 15% is a good goal to shoot for long term, to ratchet your savings up to get to that point. And then from there, start to build up some retirement accounts. So this could be just purely taxable savings outside of retirement savings. It could be obviously a host of other things, saving for a home, saving for college, whatever else you're saving for or investing for. But this is kind of a few things to think about in terms of where to start. Now, one thing that we often will work people through is basically a cash flow chart or a flow chart of navigating these things. Now, I realize this chart is probably a little bit hard to make out on your slide. I do have a larger version of this PDF that you can, if you send me an email, I'll send it to you and you can kind of zoom in and walk through it on your own. But it essentially walks you through this as sort of a decision tree. So one, think about this as when your paycheck comes in, what should you do with it? So one is obviously pay your essential expenses. You got to pay your rent, you got to buy food, you got to do those things, right? From there, the next thing you should think about is funding the emergency fund. If you don't have that, once that box is checked, are you contributing enough to get the retirement plan match? Once that's checked, move on to the high interest debt. So you basically can just walk yourself through this and as a way to set some financial goals. So again, if you want a copy of this that's a little bit bigger and easier to read, let me know and I can get that over to you. But that's the first section here on basically setting financial goals and what those financial goals should be. So I want to take a second and check in. Basically, I'll give you a second here to think about this question. But the question is, what's one financial goal you can set in the next week? And I told you I was going to try to get you to take some action here in the next week. So what's one financial goal you can set in the next week, and who would you share that with? So I'll give you a second wherever you're taking notes to think about this, write it down. And then if we have somebody that's brave, maybe willing to share what they wrote down with the group, if somebody's willing.
And let's see, Isaac, do you mind if I stop sharing your screen so we can see each other?
Perfect. Yeah, I'll go ahead. Yep, perfect.
Okay. So what's something that someone wants to share, a goal that they have?
I'll volunteer.
Go ahead, Eric.
So we're in what we call high involvement planning season in our business. And so I'm walking through that same scenario for myself personally. So I want to get a 2021 financial plan laid out. I don't know if it'll be done in the next week, but it'll be much farther along than where we're at right now.
That's a great one.
And Eric, the one comment I would have is on those longer range goals that, setting your 2021 plan is probably going to take a little bit of a while. But one thing to think about is what's an action you can take in the next week to move that forward, or what's the first step you can take in the next week, and that could be a good goal.
Yeah, I've got time blocked off on Saturday to start working on it. So it's being intentional about having time every week until it's to the point where I'm comfortable that it's actually going to be executable for next year.
Yeah, perfect.
Matt, did I see your hand?
Yeah. My goal is just to start rebuilding that emergency fund, set up an automatic transfer so that I don't have the excuse of, well, this money's here and I'll spend it on something else. Put it in a separate account and just automatic transfer it.
That's a great one too.
Yeah, perfect, Matt. That you're stealing some of my thunder for the how to stay on track. The automating the transfers is a really good strategy there.
And Ken, I saw your hand too.
Hi, everyone. A couple of years ago, probably 3 or 4 years ago now, I had to buy someone out of a partnership I had with a house, and I took a loan from my it's like a whole life insurance policy. And it's kind of been like one of these things because it's a loan to myself. It's not very high interest, but there's a considerable amount of money in there that I owe that account that I'm going to take, Matt, your idea and do an automated transfer out of my paycheck and start paying that off. It'd be good to get out from underneath that.
Yeah, that's a great one too, Ken. Jillian, go for it.
Yeah, I've been putting off adjusting my budgets. My family's income changed from COVID-19 job changes. And so I need to sit down and actually look at it, make those adjustments, and figure out our new plan.
Good one there too. And Isaac, I had a question that came in beforehand via email that I think is relevant to this. Can I pose it to you right now?
Absolutely.
So this one, when people talk about saving for retirement, this might sound silly, but does that just mean in my normal savings account?
Probably not. So it depends on what you mean by your normal savings account. But if you're talking about, you have a checking account and a savings account and money going to that savings account, no. So typically when you think about retirement, and I have some slides on this that we can get into, but typically that's going to be through your 401k, which is an employer sponsored plan, or for an IRA, an individual retirement account. There's some tax advantages to that, to saving in those ways. There's also some, I guess, self-discipline that's built into those, because you can't touch them without penalty anyway. You can't touch them until you're retired. So it's purely monies that are set aside for retirement.
Awesome. Thank you.
Yeah.
Okay. Awesome. Thank you for the input. Those are great goals, everybody.
Yeah, thank you. I would double down on that. Those are great goals. And the thing that I would encourage you to think about is, I'm reading Atomic Habits by James Clear right now. I don't know if any of you have read that. But the thing he talks about in that book is implementation intention. What is the first step you're going to take to get that goal accomplished? So setting a goal to write a book is a worthy outcome, but that's a big goal. So maybe it's block time on my calendar Saturday to write for 1 hour every Saturday, or something like that. So what is the action that you can actually take in the next week to pay down this loan, or build your emergency fund, or do the 2020 planning, or set your budget? Whatever it is, what's the one thing you can do in the next week to actually get the ball moving on that goal? So that's what I encourage you to think about. Okay, should I move on with kind of our second section, Rachel, getting into savings and investing, which kind of ties into the question that you just posed?
Yeah, perfect.
Okay, perfect. Okay, so let me share my screen again. And thank you all for your willingness to share and participating in that question. So our next section here is saving versus investing. So again, each have a role, a purpose. They are different things. And so saving is more short-term. The money should be liquid. You should be able to get access to that money, and the money should be fairly stable in value. So again, think about a checking account or a savings account. Those are more or less savings. You need those from an emergency perspective. It's money that you might touch in the near term. If you're looking to buy a car, or looking to buy a house, or something that you're going to touch in the short term, think about that more as saving. On investing, on the other hand, tends to be longer term. So could be retirement. That's kind of the normal thing that people are going to invest for, or save money to invest in. However, there's other things. College could be many years down the road, and so you're investing money for that. Oftentimes, when you're investing money, the money it can be liquid or illiquid, but in the sense of like money in a retirement account, you can't really touch that until you turn 65. So oftentimes that's many years down the road. So you can't get access to that money. And then if you're investing, particularly if you're investing in the stock market, anybody that's paid attention this year, we've had a lot of fluctuation in the value of those funds. Early in the year, dropped 35%. We're back up like 65% in a couple of months from there. In the last a month roughly, we've dropped another 10%. So the value can swing widely. And so if you need it in the short run, having that value bounce around a lot is not an attractive feature of savings, although it can be one of the reasons you can earn a higher rate of return in investing. So the thing I would encourage you to think about here is save like you're a pessimist, but invest like you're an optimist. So savings should be what can go wrong. Investing is more longer term, what's right with the world, investing in a chunk in the financial success of the companies that you're investing in, kind of what can go right there. So that's one framing to kind of think about. There's kind of two reasons we need to invest. Both of those things are important. Shifting gears to the investing side, there's really two reasons. One is oftentimes the goals we're saving for are down the road, and inflation is something that we have to contend with. Things get more expensive over time. So we at least need our money to keep up with inflation. So this is just a kind of a silly depiction, but it kind of paints the picture of what inflation has looked like over the last 100 years with milk. I wasn't around in 1918, but apparently a quart of milk cost 14 cents. Fast forward 50 years, 14 cents buys you 2 cups, and then roughly to today, 14 cents buys you 12 tablespoons of milk. So your money becomes worth less over time. So that's one reason to invest. You need to keep up with inflation, because retirement might be 30 years down the road, and $4 for a cup of coffee today isn't going to buy you a cup of coffee when you retire. So you need to grow your money to at least keep pace with inflation. The other reason to invest would be to actually make money, to actually outpace inflation. If you save money today, you're going to need to put away a lot less money today to fund something in the future if you get an investment rate of return. So kind of two reasons why we need to think about investing. While it's not enough to just say, hey, and I'll set the money aside later to pay for the things that I want down the road. Now, this goes back to the question that Rachel posed earlier. When we are investing, and particularly if we're investing for retirement, there are some ways that we can get some tax advantages to putting money away to fund something down the road. So the main tax advantage accounts are 401k. Again, that's going to be through your employer. You can't just go out and open a 401k on your own. Those have to be employer sponsored. The other is an individual retirement account. So these are ones that you could open up an account on your own. You can open up an IRA in addition to your 401k if you already have one through your employer, or if your employer doesn't provide an account, this is one that you can open up. There's essentially 2 flavors of IRAs. There's a traditional and a Roth. You've probably heard the Roth term before. Traditional works very much in the same way as a 401k, where you get a tax break today to put the money in, and then it's going to grow tax deferred over the period that you're investing before retirement. When you retire, you take the money out, and you're going to be taxed on it. Basically, it's like income. It's like a paycheck when you retire and pull that money out. So you're going to get taxed on it when you retire. Roth account, on the other hand, you don't get a tax break up front. You put money into a Roth, you're not going to get any change in your tax bill today, but over the course of that investment horizon, the money grows tax-free. And then when you pull the money out in retirement, you're not taxed on it either. And so it's a really good account if you can get some money in there, because basically once you get the money in there, all the growth and any withdrawals are tax-free basically for the rest of the history of that account, which is a really nice feature there. Pretty big benefit of getting the money into these accounts. So this is, again, kind of why you should think about, if you're saving for retirement, don't just do it in a regular account, a savings account or a taxable investment account. Take advantage of these tax deferred benefits of growth. So here we're looking at basically the 3 examples. This is a slide from Vanguard, but it basically shows the bottom is that fully taxable account. So if you were no tax break up front, and the growth is fully taxed, and when you take it out, you have taxes, right? So $266,000, that's a 30-year investment, a $75,000 initial account balance. Step up to the next line, kind of that yellow line there. This is the 401k option, where you get the tax deferred growth, but then when you pull the money out, you're taxed. And then the blue line at the top, this is that Roth account example, where both the growth and the withdrawals are not taxed. So again, if you have the ability to contribute to a Roth account, a really attractive way to defer taxes and ultimately end up with more money than you would otherwise if you weren't taking advantage of some of these tax deferred growth benefits. So hitting a couple other things with investing. So typically when we do these presentations for companies, we'll go into a little bit more details here on kind of the investing 101. So really what we're trying to accomplish here is, okay, I buy into this. It makes sense. I need to start put some money away for retirement. I can open the account, say I know I want a Roth account. I want to start putting money in there. That's step 1, get the account open, maybe do the automatic transfers to get some money in there. The next decision you're going to have to make is, okay, what do I invest in when I have that account open? And so that's what we tend to cover in this Investing 101 section. I wanted to give you just a little bit of a flavor for that and a little bit of information here as well. So we're going to get into kind of this, we have a 4-step framework that we use to go through making an investment decision counts. We'll get to that. I wanted to pause and do a pop quiz, another pop quiz here. This one I'll give you the answer right away. And I'll take some volunteers if anybody's brave. You only have 2 options, so you have at least a 50% chance. So hopefully we get somebody brave. But the quiz goes like this. Investor A saves $2,000 a year from age 26 through 65. Investor B, same $2,000 a year, but they only do it for 7 years, 19 to 26, and then they stop. And both of them get the same return, 10%. So at age 65, who ends up with more money? That's the quiz. Anybody want to raise their hand and share their guess? I see Matt.
I'm going to guess investor B.
Okay, we got 1 for investor B. Anybody else want to counter that or
Rachel,
double down?
I saw your hand, Rachel. What do you think?
Oh, I was also going to say investor B.
Okay. I don't see any hands. Oh, I see one.
Anybody think A?
No,
All right.
no one's for A.
No one's for A. We've got a smart group. I guess I knew that going in, but it is investor B, ends up with a little bit more money. And the really interesting thing about this is, one person saving money for 30 years, they're putting in roughly, $60,000 versus the other, or sorry, 40 years, they're putting in roughly $80,000 versus the other person putting in $14,000. How do you end up with more money? By putting in a lot less. And it all comes back to, compound growth of your money. So the point of this is, I don't think anybody here is 19. Maybe I'm wrong. I'm certainly not 19, but the point is earlier is better than later. This is kind of the start today. Don't put it off another year. Better to start now than later. And compound growth can be a really fantastic thing if you give it time to work. So that's the main point, the main takeaway on this is starting early. It can have some pretty big advantages. So if you do start early, you open that account, you need to know what to invest in. This is the framework for that. So there's 4 things we need to make decisions on to make that investment decision in the account. And I think they go in this order as well. So first thing is risk tolerance. How much risk should we be taking in our account? That should get expressed through what's called asset allocation. This is basically, think about stocks and bonds. How much of each do you want to have in your account? From there, we need to make a decision on what kind of funds, investment funds. If you're in a 401k, you have a lineup of options to pick from. Which of those should you pick? How do you make a decision? One of the things that we encourage people to think about is, do they want to use actively managed funds or index funds? And then from there, we get into expenses. How much are you paying to own those funds that you hold in the account? And that's something that you definitely need to look at as well. So I'm not going to cover all these in detail, but I want to just give you a sense of kind of this framework and hit a couple of them at a high level. So allocation. So once we've kind of set a risk tolerance, which would be, how comfortable are we, or how much risk are we comfortable taking, essentially, this tends to get expressed in an allocation. So allocation is I guess, kind of a finance word, a little bit of jargon, but it simply means, what comprises our portfolio. And most of the time, our options in a 401k are going to be stocks or bonds. And so here we're looking at a chart that on the far right, the bar in red there is 100% stocks. If you were to own 100% stocks, what that portfolio might look like. And on the left, the bar in blue is just 100% bonds. What you should be able to tell, or the 2 takeaways from this chart, is this bar on the right here is much wider, right? The variation between a good year and a bad year is much larger than over here if you own 100% bonds. The variation is going to be much smaller. The second thing that you should take away is all the way on the left, 100% bonds. The average return for a portfolio like that has been about 5.5% per year, versus out on the right, average return is about 10% a year. So double the return, but for that, you have to be willing to take much more risk or have much more variability in your outcomes each year. So here, the best return in any given year was almost 55%. The worst was 43%. So you can have really good years and really bad years. For that, on average, you've earned a higher return, but you have to be kind of comfortable with that. Seeing, especially as you get closer to retirement, seeing your account drop by 43% in any given year. So if you've got $1 million portfolio and it drops by $430,000, are you comfortable with that? Most people probably aren't when they're close to retirement. Maybe that's okay when you're just starting out, but most people aren't going to be comfortable with that. And so that's kind of the first two steps of this framework in a nutshell, is where on this spectrum are you comfortable being? How much of a drop can you stomach? Can you sleep with at night? And decide on that. And then from there, then you can make this decision of, okay, how much do I want in stocks and how much do I want in bonds? So obviously this can get super complicated. And if you're reading things online, everybody's got their way of determining a risk tolerance or determining the perfect asset allocation for you. But this is the fundamental thing you need to start with, is really simplify it. How much in stocks versus how much in bonds. And that should align with how much risk you're willing to take. So that's the main thing that I would encourage it to take away here. The next slide is really just showing that difference in return. It can compound into a pretty big thing. So this is what we talked about, compound growth a little bit. This is sort of showing these different growth rates over time. And so inflation, we talked about needing to at least keep up with inflation. That's kind of the bottom. Treasury bills, think about this as a savings account, essentially, have done a little bit better than inflation over time. Step up to bonds, this is that 5.5% return that we looked at. $1 turns into $142 over 90 years. So you're ahead of inflation, which is good, but there's a huge bump up to owning large company stocks or smaller company stocks, which tend to be higher risk yet than just regular stocks. And so the takeaway here is, yes, there is a pretty big step up, especially if you compound it over, say, a 30-year retirement horizon. There can be a pretty big step up to the potential return that you can get over a large time horizon, but you have to be comfortable with the risk you're taking, and you have to be willing to ride out the ups and downs. So it's hard to kind of make it out on this chart, but this is 2008. Market was down 43%. You've got to achieve these long-term results, you have to be comfortable with the amount of risk you're taking on and kind of ride this out. I saw Matt raise his hand. Yeah, go ahead.
Yeah, sorry, just a question, and maybe you can explain it at a high level. I know the details will probably confuse me anyway, but can you explain the difference between a stock and a bond?
Yeah, that's a good question. That's one that we typically have in this presentation, but at a very high level, a stock is an investment in a company, meaning you own a piece of the company. For that, you get to participate in the upside and the downside. If the company does well, if they're worth more in the future, you get a piece of that. If they're making profits, you get a piece of the profits. On the flip side, if the company does poorly, your downside is that you could lose the whole investment, right? The company could go bankrupt and that thing's worth nothing. So there's a lot of variability in the outcomes there. A bond, on the other hand, is simply a loan. And for that, you're going to get some type of an interest rate. You're going to, just like your bank pays you right now, very little, but they pay you a little bit for a savings account. Same thing with a loan. There's an interest rate associated with it, and that's your return. There's really no upside, right? You're going to get your money back and you're going to get a little bit of interest. For that, they tend to be they tend to be safer. There's less volatility or variability in the value of that. And this is kind of technical, but they're higher in the capital structure of the company. So it means if a company goes bankrupt, the bondholders are going to be the ones that get paid out first. The stock could be worth nothing, but the bondholders might recoup 80% or 90% of their investment, even in a bankruptcy. So they tend to be a lot safer. They fluctuate in value less. because of that, they earn less from a return perspective, but you still do get that interest rate associated with it. So hopefully that helps.
Thank you.
Yeah. Any other questions on this or the last couple slides that we've covered?
Let's see. I don't see any other hands. I think we're good for now.
Okay, good. So that's kind of it here on the investing section. So again, another question, and if anybody feels comfortable sharing, I'd love to hear from you all here. So I'm gonna go ahead and, I'll read the question and then I'll stop my share. So question here, and again, this would be something to maybe just at least jot down a note for, and at the end, again, I'm gonna try to get you to commit to take one action in the next week. So this could be that one action. Question here is, do I need to create an investment plan, meaning set a plan to get started, or do I need to review my current one? If you're already investing in your 401k, you need to go there and look at the options you're using or the risk tolerance that you have. So which do I need to do, and what's the first step to get started? So that, again, this is the implementation intention. What's the first thing I can do to get started here? So I'm gonna go ahead and stop my share, and if anybody's comfortable sharing a little bit here, that would be great.
Go ahead, Rachel.
So when I first started to try to have like an actual strategic plan for my finances, I set up the free account on Personal Capital. So it gave me a really good overall assessment of what my current net worth was, if I was on track to retire at the age that I want to retire, and if not, like how much more I need to save. And it also assessed my spending patterns to help me figure out what my baseline budget was, so it could tell me what my emergency savings needed to be. Because when I came up with what my emergency savings needed to be, I came up with a different number, but based on my spending patterns over so many months, it was kind of nice to see in black and white, okay, this is actually what you need to do to get on track.
Great. Yeah, Personal Capital is a good resource. Betterment and Wealthfront are two others that people could look into, and they have some pretty good online tools to do a lot of the things that you've just mentioned. So yeah, great resource.
What was the one other than Betterment you mentioned?
Wealthfront. I would probably say Betterment and then Personal Capital, and Wealthfront would kind of be third, but that is one other one that you could look at.
Great, thank you. Thanks, Rachel. Anybody else? Okay, Isaac, back to you.
Okay, we are getting some good questions throughout, and I do want to save some time for some discussion and Q&A at the end too. So I think we got one more section here, which is the shortest one and should be the quickest one, and then we can get to the wrapping up and Q&A. So we've covered setting financial goals, saving versus investing. Last section is really just about staying on track. How can we put some of these things into practice, and how do we set some sort of review with some sort of frequency so that we can make sure to stay on track on these things. So the things that I would encourage you to think about, and these could be every 6 months or once a year, something like that, of going in and doing and making sure you're on track. So first thing's already been mentioned, automate your savings. So again, things are going to be a lot easier if you will simply automate it. One less decision that you need to make. So instead of, if you want to save for retirement or build your emergency fund, instead of needing to go in every month and transfer money from your checking account into your savings account, or hopefully nobody's putting themselves through the pain of like actually writing a check every month and putting it into account or something like that. But the more you can reduce the friction, and the more you can just automate it out of sight, out of mind, the better off you're going to be, the more successful you're going to be on your goal. So first thing I would say is, as it relates to any of these goals you're setting, automate it to the extent you're possible. So to the extent possible. So that'd be the first thing. Second thing is set some frequency that you're going to go in here and review kind of your strategy. So annually is on the slide. This could be 6 months. You don't need to go in there and review things daily or weekly or something like that. But once a quarter, twice a year, once a year, some sort of frequency where maybe it's just on your calendar as a reoccurring meeting with yourself or with your spouse or with somebody else, that you go in here and review your savings plan and how your accounts are doing and how they're invested. If you are comfortable having 70% of your account in stocks and 30% in bonds, go in once a year and look at, is that how I'm positioned? Those kind of things. Third thing to do would be increase your savings rate. So we talked early on about at least contributing enough to get your retirement plan match. And then from there, another goal would be to try to bump it up to 10 to 15%. It's going to be really hard to go from saving, say, 5% to 15%. You're probably not just going to flip that switch and make the change. It's going to be much easier if you treat it more as a stair-stepped increase, right? Like over a period of time, you get your savings to where you want it to be. So I would say, one, don't think you need to do that overnight. Take an approach over time where you're increasing that. There's also a couple, I don't know, you could almost call these hacks of how to get it to where you want it to be. So one would be when you get a raise, take some of that money for yourself, right? You get a raise, you want to buy a nicer car, or you want to increase the amount you're spending on entertainment every month, or whatever it is. Take some of it for yourself, but before you kind of see that money hit your account, also put some of it into savings. So increase your savings rate at the time of a raise. So that's going to be a much less painful way to do it, right? Because you're taking some of that raise for yourself and some of that raise for your future self. Still, you're going to feel better because you get more money in your paycheck every month. So that'd be one thing to think about. The other way to do that would be there's actually programs that do this, 401k programs that do this, but you could do this on your own. It's called Save More Tomorrow. And essentially you're making a commitment now to save more in the future. So again, this makes it less painful, right? It's a lot easier for me to say, I'm going to eat healthy tomorrow. I'm going to have a salad tomorrow versus having a salad today. But yet I'm still making the commitment, and I'm going to be more likely to eat the salad tomorrow if I commit to it today. So this is kind of just a way of tricking yourself, but it could look like in your 401k, I'm saving 5% right now. I'm not going to increase my savings rate to 6% now, but in January, I will increase my savings rate to 6%. And you could pre-commit to that action that you want yourself to do in the future. So those could be a couple of tricks to increasing your savings rate over time. We didn't spend a lot of time on this, the high fees piece, but this would, the other thing you should do, at least annually, is to review your accounts, make sure you're not paying fees unnecessarily. There's nothing wrong with paying fees. We work with clients and we charge our clients for working with them, but make sure you're not paying fees unnecessarily. You're not paying for something you're not using. You're not paying for something you're not getting any value from or any benefit from. So the one thing that I would encourage anybody that has a 401k to do is, at a minimum, go in there and look at the fees you're paying for the funds you're holding. These are called expense ratios. And most of the time, it's fairly easy to get in there and see what these are. So in most 401k lineups, you can go in there and look at what they're called holdings, or maybe you click on like investments and it'll tell you your investment options. There's oftentimes a page where it says fees or expenses or something like that. And you can just click on that and it'll show you these expenses that you're paying for anything that you own in that account. These are typically expressed as percentages. And so it's a percent of the money that you have in there. So it might be 1%. And so if you own, $10,000 in a particular fund, you're going to pay 1% of that per year in fees. 1% tends to be pretty high. And so what you're going to want to do is make sure that you can lower those to the extent possible, or if you are, that there's a good reason. If you're holding one that's one of the more expensive options available in your 401k, that you kind of know why you're holding that there's a good reason for that. So that would be something that I would encourage you to do. And then the last one here is just simply stick with the market. There's going to be a lot of, when you're investing for long term, when we're investing in the stock market, there can be a lot of volatility. There can be a lot of fluctuation in the balance. And so if we want those returns that look really good over the longer period, we've got to make sure to stick with kind of our strategy over time. So there's always going to be a reason. There's always going to be negative news out there. Right now, it's the elections. Oh, hey, let me get out of the market. Let me see, what's going to happen after that. Oftentimes, we earn returns for sticking with things through periods like this. And the other piece to kind of think about, especially if we're thinking about retirement, is you're saving for something 30 years down the road. It's going to be really hard to kind of time it today and have any kind of benefit to that for something that we're going to use 30 years down the road, 20 years down the road, even 10 years down the road. It's going to be really hard to get it right in the short run. You're probably just going to stress yourself out trying to do that. And so kind of sticking with it over the long term is a key to staying on track. So hopefully that all makes sense. Any questions about any of these or any other ideas that people have, things that they've been successful with in terms of staying on track over time with their finances?
I have a question, Isaac.
Sure.
With regards to the percentage of recommending increasing your, how much you should invest, the percentage, are there any recommendations as to if this is your income, this is the percentage or the category you should be in? How do you sort of determine that? Or is it just based on your tolerance and where you want to be when you retire?
Yeah, I think it depends on what your goals are. Like if you want to retire, the FIRE movement, I don't know if anybody has heard of that. Yeah, so it's essentially I want to be financially independent as fast as possible. So maybe I don't want to have to work when I'm 45 or something like that. So it depends on your goals, right? If that's you, if you want to retire really early, you're going to need to devote a lot more of your savings or a lot more of your income to savings, right? Versus, hey, for me personally, I like working. I don't really see myself retiring by 50 or whatever. That's not really a goal of mine. I like working, it's not like a manual labor job. I can probably do it from time. And so that would be less important to me. So it kind of depends on your goals, right? I would think about it more as a percentage of your income than based on your income, right? So it's more just a percentage amount. The one thing you're going to run into as you earn more income, there's only a certain amount you can contribute to a 401k. There's an actual limit per year. Same thing with an IRA. And that's actually a lot lower of a limit than a 401k. And so if you earn a high salary and you're saving 15% of it, say, you might have to start thinking about other places to save that money. That's maybe where you get into needing to save some money into a taxable account because you've maxed out these retirement accounts. So that would be my advice is one, it depends on how much or what your goals are, how aggressive you want to be, how much, it's just a trade-off. Everything in life's a trade-off, right? How much do you want to enjoy life today versus how much do you want to, be able to stop working or be independently wealthy, in the future or pull that in. And then the other thing to think about is just how much can you afford and kind of do a percentage of your income versus I need to do this amount per year kind of thing.
Thank you so much.
Sure.
Other questions? And feel free to send them in the chat. And if you're nervous, you can send them directly to me and I can keep you anonymous. So don't worry about that. Go ahead, Yvonne. There we go.
Hi. Yeah, here's a question. I have an emergency fund, and so I have extra cash that used to go into the emergency fund, and it's at a level that I'm comfortable with. So I've started making additional house payments, if you will, just adding to that, which it's an interesting thing because depending upon which investment guy you talk to, some say, oh, don't put it there, you should create another account. And so what is your opinion on that?
Yeah, a good question. So one, congratulations for getting the emergency fund where you want it to be. And then two, congratulations for putting that money towards some other financial goal and not, I don't know, blowing it on whatever. So two good things you've done already. So good job. I think I said this at the beginning, it depends. It depends what your goals and objectives are, and it depends on your risk tolerance. So I'm not one of these investment guys that's going to tell you you're doing it wrong either way. It's kind of an individual answer, but the way I think about it, the way we advise clients to think about it is, what are you comfortable with? Some people really value, I have my home paid off, it helps me sleep better at night, and it's more of a comfort thing and a risk tolerance thing, right? It makes me nervous to have debt on my residence. So if that's you and it makes you nervous to have debt on your home, or it would make you feel a lot better, more financially secure to have it paid off, then paying extra on your mortgage is probably the right decision for you. On the other hand, if you purely view a mortgage as a financial decision and you're comfortable with debt, which I tend to fall in this bucket, right? I'm comfortable with it and interest rates are really low and I can probably earn more money than that over a longer period by taking that extra money and investing it. Then that's the right answer. So it really kind of depends on how you view it. If it helps you sleep better at night, if you feel more financially stable, in control, ultimately, if it lets you do the things you want to do in life, paying off the mortgage is the right decision. If you purely just view it as another finance decision and it's cheap money, and so I want to take my money and invest it elsewhere, that might be the right call for you. So kind of, it depends based on you and your situation, I would say is the first thing.
Okay, so if it almost becomes an emotional decision if that's where I'm comfortable, in essence, right?
Yeah, I think so. I mean, purely from a financial standpoint, I would say if, depending on what your interest rate is, if you have an interest rate above 4, you should probably refinance anyway and get a lower rate, right? Which, yeah, good. And then, so then it becomes a purely financial decision would be, yeah, if you're investing for a longer period of time and you're okay not touching that money for 10 years, you're probably going to be better off investing the money purely financially. But that's not the only criteria that we need to look at. The other criteria we need to look at is, what are you comfortable with? And if it makes you more comfortable to have the mortgage paid off, then like, great. That's not a bad decision.
Okay. I appreciate that insight.
Yeah.
Thank you.
Thanks, Yvonne. And then Matt asked, in your opinion, is it more important to maintain the right asset allocation or to pick the right stocks and bonds?
Yeah, that's a really good question, Matt. There's been research done, I think it was like in the 1980s, and they looked at this exact question. What's more important, asset allocation or individual stock selection or fund selection? And what they came up with, and I don't think this is technically correct, but it's directionally correct based on prior research. But what they came up with is 89% of your investment outcome is going to be driven by your asset allocation. So your mix of stocks and bonds. So that is, I'd say, far and away the most important decision to make. Now, are there counterexamples or are there some pretty extreme examples? So for example, if I owned 50% Tesla and 50% of cash, I'd have a much higher return than I just had 100% stocks this year. Like, you can paint the example of the counterexample, but for all intents and purposes, you should think about asset allocation as being kind of that most important decision that you can set. It should drive, especially over a long time horizon, especially in like a 401k or using funds and things like that, that should drive or be the primary determinant of the return that you get over your, whatever your investment horizon you have.
Thank you, Matt. Let's see. It sounds like a Roth IRA is the best option. If you do have an employer-sponsored 401k, do you recommend also opening an IRA?
So I would say Roth accounts are the most tax advantageous accounts. However, with a 401k, what you get is your employer match. So again, that's free money. So you want to at least contribute enough to get the match. And then if you still want to contribute more, I would say, yes, think about a Roth. The other thing to think about with a Roth is there's income limits. So if you make too much money, you can't put money into those accounts. And so this would be another reason to start now. If you've got kids, employees, if you are under these income limits, like, do it now before you potentially get above them and you can't contribute to the account.
Okay, perfect. And Rachel, I saw your hand.
I'm just curious if anyone any of the small business owners offer Roth 401ks as part of the retirement planning for their employees. I want to start a program that has both traditional and Roth 401ks, but I'm not sure like what providers might offer that.
Yeah, I don't know off the top of my head. I do know that Roth options in a 401k are becoming more and more popular. A lot of the large employers are definitely doing that. And so it's definitely something that you could probably expect from other providers going forward, but I don't have any specific names for you. I'm sorry.
Go ahead, Ken.
So, Rachel, I've got a company of 12 employees, including me, and we have both Roth and traditional 401k options. So the company that manages our 401k for us is called CUNA Mutual. I think they're based out of Kansas. And I don't know if this is true, Isaac, but I kind of have the opinion that if they offer a 401k, they probably offer both flavors of 401k. And then it's really up to my employees. And there's a split. Most of them are traditional and a few of them are Roth. And it's up to them to decide which one they invest in.
Yeah, I mean, I think it's up. Different providers are going to offer the different options, and it's kind of up to you as an employer to kind of design what the plan looks like. And then from there, it would be up to the employees to pick, which account they want to invest in. Oftentimes, that's going to be driven by your tax situation. Do you need the tax break now? Would you benefit from the tax break now, or do you not need the tax break and then put the money into the Roth long term? Some of it's also just a bet on what tax rates are going to be down the road. Are they going to be higher or lower? And then that could factor into the decision as well. Really hard to predict that, though, however. And so the other thing that I would think about versus a traditional versus a Roth is essentially gives you flexibility. Down the road, if you have both, and if taxes are high, pull from the one that's tax-free, right? It gives you a way to kind of manage your taxes better if you have both options down the road when you are pulling money out of these accounts.
Thank you, and thanks for that, Ken. We're right at 2:00 here, so we do want to end on time, but Eric, I saw your hand, so I'm gonna connect you with Isaac right after this. And thank you, Jillian. Jillian just chatted Isaac's email as well.
Yeah, I was just going to quickly echo for Rachel.
Yeah.
We're 20 people. We use LT Trust. We offer both traditional and Roth IRAs through that for our employees as well. So it is an option.
Awesome.
Perfect. Thank you, Eric. So Rachel, if I can just say two things really quick before we wrap up. Thank you for having me. I've enjoyed this and some really good questions. So appreciate that. Two things. At the outset, I made an offer, which is we do presentations like this. We have a few other topics that we do into employers. So if you think your employees would benefit from something like this, my email is in the chat. And so reach out and get in touch. We can have that conversation. The other thing is we offer through these conversations a 15-minute chat, just if you want some help kind of getting started in the direction you're trying to go, or if you have other wealth management type questions, we're happy to chat there. So again, email's in there, reach out. The last thing I said, one of my expectations was to get you to set some financial goals or to get you to take some progress in the next week. So I would encourage you to, you've written down some things throughout this presentation, maybe circle the one thing that you can do in the next week to help you make progress in the direction you're trying to go. So that would be my challenge to you. I forgot 3 things. Sorry, I promised an answer to the trivia question. So I don't want to leave you hanging. Steve Jobs or Tim Cook. In interest of time, I'll just jump to it. The answer is actually, and I'll show you the slide here. The answer is actually Tim Cook. Kind of who would have thought? Hard to predict, but Tim Cook became CEO of Apple in early 2012. Over that tenure, Apple has increased from under 400 billion in assets or 400 billion in market cap to 1.8 trillion. So 82% of the value that Apple's created over its history has actually been when Tim Cook has been CEO. So I think there's 2 points to this. One is it's really hard to predict the future, but we can take some action today. The second part is Steve Jobs obviously got something really good going, but this notion of compounding growth over time, and that something that was a successful company can turn into something that's just, the largest company in the world if you just keep compounding and start early and do it over time. So two lessons from that. Hopefully, that was a little bit of fun. I like trivia, and thanks for sticking with us through the end. I think my bribe worked across the board. So.
I think so too. Thank you so much, Isaac. Thanks everybody for joining us. Look for some follow-up resources from us tomorrow, and we hope to see you all soon. Thank you.
Thank you.
Okay, well that's it for this one. Check out more Small Giants workshops at smallgiants.org.